What's up, everyone? And welcome back to B&R Blueprint, where we break down real financial stories and turn them into lessons you can use. Now, you might think that someone like Warren Buffett, with all his experience and billions of dollars, wouldn't make big mistakes, right? Well, today, we're diving into one of Buffett's biggest missteps, the $37 billion acquisition of Precision Cast Parts. And trust me, there are some seriously valuable lessons here for every investor, big or small. So buckle up, because we're about to dissect this deal, figure out what went wrong, and most importantly, see how you can avoid making the same mistakes with your own hard-earned money. All right, let's rewind back to 2016. The economy is humming along, and Warren Buffett, the Oracle of Omaha himself, decides to make a massive purchase. He buys Precision Cast Parts, a company that makes complex metal components for airplanes and power plants for a cool $37 billion. Now, that's a huge chunk of change, even for Buffett, but he saw it as a classic long-term value play. Precision Cast Parts was a leader in its industry, supplying parts to Boeing, Airbus, you name it. They had a solid track record, and Buffett figured they were poised for continued growth. Plus, he really liked the management team. He often talks about betting on the jockey, not just the horse, and he clearly trusted the people running the show at Precision Cast Parts. So the deal went through, and everyone waited to see Buffett work his magic. Here's where things get interesting. Remember how I said Buffett loves long-term bets? Well, sometimes the market throws you a curveball, and in this case, it was a massive industry-shaking curveball. First, the aerospace industry, which Precision Cast Parts relied heavily on, hit a rough patch. Boeing, one of their biggest customers, was dealing with the whole 737 MAX debacle, and demand for new planes started to slow down. Then, bam! The COVID-19 pandemic hits, and the entire travel industry goes into a tailspin. Airlines are grounding planes, orders for new aircraft plummet, and suddenly, Precision Cast Parts is left with a whole lot of expensive parts and not enough buyers. This perfect storm of bad luck forced Berkshire Hathaway to write down a whopping $10 billion from the value of Precision Cast Parts. That's right, 10 billion with a B. It was a stark reminder that even the smartest investors in the world can misjudge a situation. Now, what's fascinating about this whole situation is how Warren Buffett himself reacted to it. He's known for being pretty open and honest about his mistakes, and this was no exception. He came right out and said, "I paid too much for the company." He admitted that he got caught up in the company's past success and his faith in the management team. He didn't fully anticipate how external factors, like a global pandemic, could completely upend an entire industry. But here's the thing about Buffett. He doesn't dwell on mistakes. He analyzes them, learns from them, and moves on. And that's a powerful lesson for all of us. This brings us to the first big lesson from Buffett's Precision Cast Parts blunder. Don't chase past performance. Just because a company has a history of crushing it, doesn't mean they always will. It's like assuming a basketball player who scored 30 points a game last season is guaranteed to do it again this season. You have to look at the current situation, the competition, and the overall landscape of the game. The same goes for investing. Don't just look at a company's stock chart from the last 5 years and assume it's going to keep going up. Dig deeper, look at their financials, their management team, their competition, and think about the future. Are they still innovating? Are they adapting to changing market conditions? Past performance is just one piece of the puzzle, not the whole picture. The second lesson is all about industry cycles. Some industries, like aerospace, are cyclical. That means they go through periods of boom and bust, often influenced by things outside their control. Think about it. When the economy is booming, people travel more, businesses invest in new planes, and aerospace companies thrive. But when the economy slows down or something unexpected happens, like a pandemic, the whole industry can come screeching to a halt. Buffett underestimated how vulnerable the aerospace industry was to these external shocks. He focused too much on the company itself and not enough on the bigger picture. So, what's the takeaway here? Before you invest in any company, take a step back and look at the industry as a whole. Is it a cyclical industry? What factors could impact its growth or decline? Understanding these cycles can help you make smarter investment decisions and avoid getting caught in a downturn. Now, this next lesson is one that Buffett himself has preached for years, but even he slipped up this time. The lesson is simple. Price matters. It's better to buy a great company at a fair price than a fair company at a great price. Buffett is a value investor at heart. He looks for companies that are undervalued by the market, businesses that are worth more than their current stock price suggests. But with precision cast parts, he overpaid. He got so caught up in the quality of the business and his belief in its long-term prospects that he didn't wait for the right price. And that's a trap that any investor can fall into, especially when you're excited about a particular stock company. Remember, no matter how great a company is, overpaying can significantly impact your returns. It's like buying a used car. You might find a fantastic car with low mileage and a pristine interior. But if the seller is asking way above market value, it's still not a good deal. Chapter 7. This next lesson might seem counterintuitive, especially coming from Warren Buffett. He's always emphasized the importance of investing in companies with strong management teams. And while that's definitely important, Buffett's experience with precision cast parts highlights that even the best management teams can't control everything. Buffett clearly had a lot of faith in the leadership at Precision Cast Parts. He trusted their track record and their vision for the future. But even the most skilled and experienced executives can't predict or control black swan events like global pandemics or sudden industry downturns. The lesson here is to not get blinded by a star CEO or a management team with a stellar reputation. While strong leadership is a positive sign, it's crucial to evaluate the company's fundamentals, its competitive landscape, and the overall industry outlook. Don't let a charismatic CEO overshadow potential red flags or risks. This final lesson is more about mindset than anything else, but it's arguably the most important. Warren Buffett is known for his humility and his willingness to admit when he's wrong. He doesn't make excuses or try to sugarcoat his mistakes. He owns them, learns from them, and moves on. And that's a powerful trait for any investor to develop. It's easy to get emotionally attached to our investments, especially when we've spent hours researching and analyzing them. But the market doesn't care about our feelings. If we make a mistake, holding on to a losing investment out of pride or stubbornness will only hurt us more in the long run. It's crucial to be honest with ourselves, acknowledge when we're wrong, and be willing to cut our losses. Remember, in investing, it's not about being right all the time. It's about managing risk, learning from your mistakes, and making smarter decisions over time. Chapter 9. So, there you have it, the story of Warren Buffett's $37 billion blunder and the invaluable lessons we can all learn from it. Now, you might be thinking, that's great, but I'm not Warren Buffett. I don't have billions of dollars to invest, and you're right, most of us don't. But here's the thing, these lessons apply to investors of all levels. Whether you're just starting out with a few $100s or you've been investing for years, the principles are the same. Do your homework, understand the industry, be mindful of timing, don't chase hype, and always leave room to be wrong. Remember, investing is a marathon, not a sprint. It's about making smart, informed decisions over the long term. And sometimes the best lessons come from the mistakes of even the greatest investors in the world. Thanks for watching B&R Blueprint, where we turn billion-dollar mistakes into priceless lessons. Now, it's time to test your Warren Buffett knowledge. Trivia time. What company did Warren Buffett call his greatest mistake before Precision Cast Parts? Drop your answer in the comments. We'll feature the first correct response in our next video. And don't forget to smash that like button, hit subscribe for more financial deep dives, and let me know in the comments what other topics you'd like me to cover. Until next time, keep learning, keep growing, and let's build smarter together.